Good afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Today, we continue our webinar series surrounding COVID-19 and the global pandemic's effect on the automotive retail market. Before I introduce today's presenter, a few quick reminders as always. Everyone that is registered for today's program will receive a copy by early next week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Today, we welcome back Charlie Chesbrough, Senior Economist at Cox Automotive. Charlie, it's been a very busy last couple of weeks, and I'm sure you have a lot to cover, so I'm going to hand it over to you.
All right. Well, thank you so much. And we certainly do have a lot to discuss, and we're going to give you the update as to what we're seeing out there. But just to really quick take you through the agenda, I'm going to give an update on what we're seeing out there regarding the virus, the economy, and the vehicle market. And then I wanted to take you through a little bit of the analysis that we've been doing, looking at how this virus has impacted the market, sort of on a year-over-year and a year-to-date basis, how it's impacting segments, how it's impacting different brands, and as well as different states, because I think that's certainly an important ingredient. And then I'm going to finish by talking about what next. And that's really kind of the big question right now that we're all wrestling with is where do we go from here? Because there's a lot of mixed signals out there. But let's get started. Let's start by talking about the virus itself. We're now over 106,000 people that have died. We're around 2 million cases identified, and it's going to continue to grow. But I think what this map illustrates, this is showing the level of severity of this pandemic by different counties around the country. And the blue are the counties that are really not that impacted right now, or they haven't seen a lot of new cases. In red, we're seeing that there's still a growth in new cases. So they're still in sort of the worst stages of this virus. But I think one thing that's important that kind of emerges from this map is that it's really not one pandemic, but it's scores of pandemic. It's 100 little pandemics that are going on out there because it's a very geographically based issue that we're dealing with. If we look at this in the aggregate, the number of cases are declining. If we look at it as a national total, the rate of death has been declining. It does appear that we're on the opposite side of this. But really, that's being led by the significant improvements that we're seeing in sort of the worst hit states, like in New York and New Jersey and in Michigan. Things have improved dramatically, but we are starting to see that new infection rates are increasing in various parts of the country, and certainly the Southeast as well as Texas. We're hearing that the rate of infections is starting to grow. And so that's really disconcerting. And of course, all of the turmoil that we've seen around the country here over the last week and all of the protests, certainly we're not seeing social distancing out there. And I think that that's going to spell more trouble for all of us here in the coming weeks. So unfortunately, the news on this virus remains mixed. It's getting better in the places where it was bad. But I think it's getting a little bit worse in some places where it hasn't been such a problem before. But probably the bigger issue we're dealing with right now is the economy. And we've seen, this is a map that's showing the states that have been worst hit by weekly initial claims. We had a number that came out today, another 1.9 million job claims were made over the last week. So almost another 2 million people that have lost their job. We've had 42 million total weekly jobless claims made since March 15th. So it's really just the magnitude of this cannot be overstated. The expectation is that when they release the unemployment number for May tomorrow, the Department of Labor, we're expecting the unemployment rate is going to be north of 20%. So we really are in historic ground. We haven't seen levels like that since the worst of the Great Depression back in 1932, 1933. So this is the problem we're dealing with right now. Now, we are seeing openings around the country. We are seeing that some businesses are rehiring people, and that's really sort of the key right now. That's the V that we're hoping for, is can these businesses start to rehire and bring those workers back before the money runs out? And there's some real issues that we're facing here over the course of the summer where this problem could get substantially worse. One number that I've been hearing about is the fact that state and local governments around the country have their fiscal year that starts in July. And by then, they need to have balanced budgets. And one of the things that's by law, they have to have balanced budgets. In order to get there, many of them are going to have to start laying off employees because their pension costs are fixed. There's nothing they can do about legacy costs. It's all the variable. It's the current employment conditions that are going to have to change in order to balance those budgets. So we're starting to hear some concerns out there that a lot of state and local agencies around the country may have to start laying off people in July if we don't get another bailout package from Congress. And they've been asking for it. But right now, not a lot is getting done in Congress because of all of the turmoil we've seen over the last week. So that's one of the things that we're quite concerned about. But as I said, the expectation is that unemployment is going to start to improve here once we get into the third quarter, that we should see most of the country reopened at that point. The restaurants will be rehiring, the retail stores will be opened up again, and they'll start rehiring their employees. But it's going to be a long summer, and it's going to be a slow process. One of the things that's been very interesting since we last spoke is the Federal Reserve Chairman made some comments about 10 days ago, and he was talking about where job losses have occurred. And he mentioned that since mid-March, about 40% of Americans that make, or American households that make less than $40,000 a year have lost a job. Yet only 13% of people who that make over $100,000 have lost a job. And I think that's part of the reason we're seeing such strength in the stock market, as well as the vehicle market showing some signs of recovery, because our natural vehicle buyer out there and the natural investor into the stock market hasn't been hit quite as hard from these job losses as has the hourly worker who isn't a new car buyer. You know, we got to be careful when we're looking at these numbers, but in general, the news remains mixed. Now, one of the things we are following closely is consumer sentiment, and we've got to have consumers that are optimistic on their outlook and on their economic conditions, where they're not going to be going out buying a new vehicle. And what we can see here from Morning Consult, they survey thousands of people every day to get a sort of pulse of what consumer sentiment is in the country. We can see that in the depths of this crisis, consumer sentiment fell dramatically, about 22%, till it hit bottom in early April. And now it's slowly making a slow recovery. But what we've seen, and this is data as of the end of May, what we're seeing in the early parts of June is that this is sort of stagnating, that we're sort of bopping around here, flatlining at around an 87 on this metric. Much of that may be attributable to the fact that we've had all of this turmoil in the country over the last week, so folks are a little bit apprehensive about that. But certainly it does suggest that we've had a little bit of a recovery. People are starting to get a little bit more comfortable, but maybe we're stagnating at this lower level, and that's real concern because we do want to see this continued V recovery where confidence is coming back, and it appears that that's not quite the case. It's starting to slow down a bit. But that said, we are seeing changes around the country. Sometimes it's very dangerous just to look at the aggregate because, as I said, this is a very geographic issue. And on the left here, I'm showing the change that we saw in consumer sentiment from February 29th through the beginning of June. And we can see that in different DMAs around the country that we saw consumer sentiment fall very, very hard. That's in the dark red. But in yellow, you can see the consumer sentiment didn't fall quite as much. But what we can see is that since May 25th, just over the last week, we're showing a lot of places where it's getting green, that we are starting to see some improvements in consumer sentiment. And in some of these markets, these are some of the hard-hit virus markets that are now feeling that they've turned a corner. But we are also seeing the yellow markets, that places where confidence is starting to make a turn. So again, this is a very geographic issue, and it's very difficult to kind of come to any kind of conclusions when we're only looking at this in total. Now, one of the things we're doing at Cox Automotive is we're surveying a lot of folks on our online shopping sites to get an idea of what are they saying out there, people that are looking at buying a vehicle. And we have a survey where we actually have folks that are intending to buy a vehicle sometime in the next 6 months. And we ask them, are you planning to delay their vehicle purchase? And what you can see here on the left is this number sort of peaked out at about 35% of people that were going to buy saying that they were going to delay. We sort of stagnated there for a bit until about mid-May when it started to take a dip. But our most recent measurement, you can see it made a big jump. We're now up to 37% of folks saying that they're going to delay purchases. And I think we're seeing a little bit of a rising concern out there. Folks are looking at the civil unrest. Vehicle buyers, six-figure income folks are saying, boy, maybe I need to slow down a little bit because maybe we're going to see this recovery derailed a bit because of all the turmoil we have out there. And so how long are they going to delay? Well, that's also been making an interesting move. You can see on the right, we've been asking folks if you're going to delay your purchase, for how long are you going to delay that purchase? And we can see that the most recent data points are suggesting that we've had a big increase in folks delaying up to 2 months. In some ways that's a positive sign, but it may also be showing that people are shifting from sort of not sure or even longer. They're moving into other categories. But I guess the one takeaway I would have out of all of this is that there's still a tremendous amount of uncertainty out there, and vehicle buyers, who we know are six-figure income folks, are very concerned and may pull back from the marketplace because if they don't see this virus get under control, if they don't see these riots get under control, folks, I think, are going to see their consumer sentiment start to fall, and they're going to pull back from the marketplace. And so I just think it's something we got to be prepared for, that this recovery may not be as fast and furious as we all hope it will be. But we are starting to see some positive signs in other areas. We also ask folks about servicing their vehicle. Will you delay? And as you can see on the left here, that we topped out in early April with about 40% of folks that were going to do servicing saying no, they're going to wait. They're not going to spend that money right now, which I think makes sense with all this turmoil and economic downturn. Folks want to conserve a little bit. If they don't have to get that vehicle repaired, they're going to hold off on it. But this number's been falling and consistently falling. So I think folks are feeling a little bit more comfortable with making that service repair. At a minimum, they don't want to take the risk of driving around in a vehicle that's not safe. So we are seeing that folks are making that repair. And we also know that a lot of dealers have made a change in how they're providing fixed ops, that they are offering sort of hands-free service to folks where you can drop off the vehicle. You don't have to talk to anybody. You don't have to touch anybody. They can fix your vehicle and bring it back to you all wiped down. I just had this experience myself. I did an oil change last week, and that's exactly what happened. I never even saw my dealer or the repair guy. It was all done with a non-face-to-face exchange, and I felt very comfortable with that. And I think we're going to find more and more dealers that are offering that capability are going to find consumers willing to come out and get that repair done, as long as I can maintain my personal safety. We're also seeing some other measures out there which are showing positive signs. Our Auto Trader shopping sites, as well as Kelley Blue Book, are still seeing a lot of activity. We know that folks are stuck at home. People are working from home because offices are closed down, and they're shopping for vehicles. We've seen a lot of activity over the last few weeks during this crisis of people looking at new and used vehicles. They're very interested in it. I think it's an aspirational product as people feel a little bit more confident and that there's light at the end of the tunnel. One of the things people want is a new vehicle, and certainly cheap gasoline out there is, I think, going to help. As I've mentioned before, I think that's really going to help people feel more comfortable about this recovery, about purchasing a new vehicle, because nothing makes people happier than cheap gasoline. And so I think that's all contributing to this environment of people being interested in vehicles. We're also seeing at dealer.com that new and used vehicle form submissions are doing well. But we have seen that this has been fits and starts. We saw some declines over the weekend. We saw DealerTrack credit applications were down a little bit week over week, but that's much better than where we were at just a few weeks back. So we are seeing movement and much more activity. And then Xtime, which is also looking at vehicle servicing, was down 37% year over year. But again, that's showing gains that we've had over the last few weeks through the worst of this crisis. So things are moving in the right direction, but it's just not happening as quickly as I think we all would like. So here's some data of what we have the ability to look at, which I think is very useful. We have a number of dealers that we track from our DealerTrack database where we can look at same-store sales, same day of a week, year over year. So it's really sort of an apples-to-apples comparison as to what's going on in the marketplace. So this isn't the broader market. This is just sort of a subset. So it's not reflecting the entire market. But I think it really reveals sort of the issue that we're dealing with right now. We can see that vehicle sales bottomed around the very end of March, early April, down about 75% on a a year-over-year basis, and then we've been on this slow recovery path. But you can see the most recent data points are sort of stagnating a little bit. And in fact, we've had a couple of downticks. I don't think Memorial Day really was the blockbuster that we had all hoped it might be. Certainly the sales for the month were up, and I'll talk about that in a moment. But we are seeing some signals that compared to what we did last year, Memorial Day was not as robust as we might have hoped for. But I think this is also suggesting, as we say, that we are seeing some stagnation in the market. You can see from this data as well that it's not this clear upward trajectory that we've been hoping for. But when we look at the used side of the market, it's a little bit of a better story. It's only down about 21%. Again, this is same store sales that we're looking at, and has made significant gains, but it too is down. But I think it's interesting to note that the used market is not down quite as much. This is what we would expect. There's much less expensive products in the used market, and it's probably pulling some folks from the new market into the used market, which is why the decline is not quite as much, because there's real value in the used market. And I think we're going to find, and I'm going to talk a little bit about this in a moment, but I think we're going to find that used vehicles out there are going to provide a new competitive threat to used vehicles. But one of the other things we're seeing out there is what's happening at auction. And there was a lot of concern in recent weeks that there was this buildup of inventory at auction, and that because all of the open outcry vehicle auctions have been shut down around the country, that there was this overabundance of supply. And once these auctions opened up, we were going to have just a tremendous sell-off into the wholesale market, driving down used vehicle auction prices and really causing a lot of trouble for everybody, certainly for the finance companies that have residual values that they want to reclaim. And that's what we can see happening there in orange, that wholesale prices fell dramatically. But what we can see now is that they're starting to recover, and this gap is essentially gone between wholesale prices and retail prices. So there is sort of some balancing that is happening out there, and really that's due to the strength that we've seen in the used market. And when we look at what's happening from a retail side in the used market, that's what that blue line is there. Retail prices have fallen, and certainly fallen relative to where we were last year, but it does appear to be stabilizing. We don't see any kind of significant collapse here at this point. So there is a lot of activity in the used market, and I think that's where we're going to see probably the most activity over the course of the summer, particularly as the new market is facing sort of a new hurdle, which is inventory supply. And I'm going to talk about that in just a moment. The other thing we're seeing in the used market is that days supply in general has come down. This is showing the 7-day retail supply and the 7-day wholesale supply. We can see that it spiked in early April, along with sort of the worst of this crisis hitting the vehicle market, but it's made substantial gains from there. And again, I think we're seeing from a lot of activity in the used market as consumers are looking for value out there in the marketplace. The selling rates for used vehicles is returning at a fairly quick pace, and that's pulling down this available inventory. So that's helping to support vehicle prices in general. And as I said before, I think the used market is going to be a real focal point for consumers here over the course of this summer. The other interesting thing that we've seen in recent days is this 0% financing. And this is showing the share of 0% financing out there in the new vehicle market relative to the entire marketplace. And you can see about 1 out of 5 vehicles purchased out there had this 0% interest rate. And this was something that the OEMs aggressively pursued as we hit the worst of this crisis starting in late March. They went really aggressive with 0 for 84 offers on some pickup trucks, and almost everybody's offering a 0 for 36 or a 0 for 48 at this point. Some manufacturers offering 0 for much longer. But I think that if there's any cure for the COVID virus, I think the only thing we've found so far is 0% financing. That seems to be moving the needle. But that said, I think what we're going to see over the course of the summer is that the manufacturers are going to pull back from some of their aggressive incentive offers. There's going to be a real limitation of product out there, and they're not going to have to be as aggressive as they might have otherwise, because we're starting to see that the days supply and inventory levels are getting a little bit thin out there in the new vehicle market. And that's going to allow the manufacturers to tighten their wallets a little bit and not have to be as aggressive on their incentive offers that they have out there. But certainly 0% financing is a way to really move this needle. The one thing I would really suggest to everybody is you have somebody sitting across from you thinking of purchasing a vehicle. If you can just add a year to that term, go from a 60-month term to a 72-month term or a 48 to a 60, that may be the easiest way to knock off hundreds of dollars off that monthly payment. And we know consumers are shopping on that monthly payment. So the longer the loan terms that you can offer, that's really going to be able to put the smallest monthly payment in front of that consumer. And when we're in the depths of this economic crisis like we are, that may be the deciding point that really changes that consumer's mind to make that purchase. So let's take a quick look at what we know out there in terms of how this virus has impacted the marketplace. So I wasn't quite sure how to do this. So what I pulled is I pulled data that we have here at Cox Automotive, and I looked at a year-over-year basis, March 1st through May 30th. How did sales this year compare to last year? And when we look at sort of second quarter sales, if you will, nationally, the sales numbers went down 43%. But if we look across the different states, there's quite a variation in terms of what states were down much more than that and what states were down not nearly as much. And if we had to look at sort of the loser, if you will, in terms of lost volume, Pennsylvania, compared to the same period last year, was 64% lower. So that's a substantial decline. We know Pennsylvania had shut down for a period of time, and we know that they, certainly Philadelphia and other big cities have been hit hard by this virus. And that's certainly being reflected in the sales numbers. On the flip side of that is Arkansas. Now, it's a small volume state, but they were only down about 14%. And so that's why they're highlighted in blue here. This is one of the things where the states that did not shut down, the states that remained open for a long time, that were not hard hit by this virus, they were able to keep their sales going. And that's being reflected in this sales map when we look at it nationally. If we look at the same analysis, but then look at states' share of the national total, what we can see is that during this period, comparing this period to last year, Texas has made substantial gains in increasing its share of the marketplace. It grew about 2.1%. And where did they steal that share from? Well, they stole it from New York, Pennsylvania, California, New Jersey, the hard-hit COVID states that shut down early and for a long period of time. So the question is, can this be sustained, or is this sort of a temporary issue? Well, I think that's something that we're going to have to watch as we go forward. But I think one of the real contributing factors that we see happening out there in the marketplace has been these 0% financing offers and the consumer's appetite for pickup trucks. And this is looking at year-to-date sales, 2019 versus 2020. So the year-to-date change, the first 5 months of the year. And I just pulled out the 15 sort of largest volume products out in the marketplace. And what we can see here on the far left is the Nissan Rogue year-to-date is down about 40%, substantially. And I think that can be attributed in part to maybe it's kind of an older product. People aren't as attracted to it. And it's a very competitive segment. But also we know that fleet activity has dried up substantially. We saw some of the fleet activity for May was down, I think, over 80% year over year. So fleet activity has really dried up in the marketplace. Rental car companies are not as involved in acquiring fleet vehicles because business travel is on hold, family travel is on hold, and that's going to impact Nissan because they're a very heavily fleet-focused company, and Nissan Rogue is a heavy fleet vehicle, and so we can see huge declines there. And on the flip side, we can actually see the Chevy Silverado is actually up on a year-over-year basis on volume. Even the depths of this crisis, you can't keep folks from buying a pickup truck. And if you look across, you can see Tacoma, Ram pickup, F-Series, they're down, but not down as much as sort of the national average. And so there's a lot of interest out there in pickup trucks. And part of that was driven by these really aggressive financing offers that the industry started launching in March towards these pickup trucks. And in some ways, I'm a little concerned that maybe they pulled ahead some of these pickup buyers. Folks that really had no intention of buying a pickup that soon just saw this incredible offer and said, I'm going to go for it. In fact, we did some of our own back of the envelope calculations, and we saw that for some manufacturers, they were offering 0% financing for 84 months, and you didn't have to make a payment for 6 months. So a lot of folks we had heard some anecdotal stories of people who had bought a truck within the last year, decided to turn it in, roll over whatever equity loss that they had into their new 0% financing rate, and lower their monthly payment still as a result, and still not to have to pay anything for 6 months. So we think a lot of folks actually just took advantage of that, not really sort of pulling new buyers into the market, but just sort of servicing people that were going to buy anyway, or people who had bought recently were just taking advantage of the offer. So I think that we're going to see some substantial changes as a result of a lot of that aggressive pickup incentive offers that we had earlier in the spring. But it's having ramifications across the entire industry. And if we look at by segment where we've seen volume changes, we can see that luxury car, subcompact car, full-size car, your hybrid cars, there's a pattern here, right? Car is all down substantially. And at the other end of the spectrum, we can see mid-size pickup, full-size pickup trucks are down just a hair, but certainly not down as much as the overall 23% that the nation is down on a year-to-date basis. You can see on the far right there, electric vehicle is actually a little bit higher. That's a little bit of a misnomer, and that's all Tesla. We're showing that Tesla sales volumes actually have improved from where they were last year. I would take it with a grain of salt. Between you and me, I don't know that I really believe the numbers I see out of Tesla, but if I accept them as real, I think we can probably attribute that to the fact that Tesla generally just goes direct to consumer. So the shutdown of dealerships around the country maybe didn't impact their business as much as it might have impacted others. And we look at changes of who won and lost in terms of market share. I think the real story here that jumps out is full-size pickup truck. If we look at year-to-date this year versus year-to-date last year, full-size pickup truck has picked up almost 3% market share. I mean, that's a monster move. I think the question for the industry is that sustainable through the course of the summer? And we're already starting to hear a lot of stories that pickup truck volume, available volume out there at dealerships is getting pretty thin. So it may be that we're going to see the pickup truck is not going to be able to maintain these levels over the summer, which will give some opportunity for other products there to maybe grab back some of that market share. One of the interesting things that has kind of emerged is that there's a real decline in compact car. And it's a little hard to kind of evaluate some of these share changes when you're looking at cars, because we know in general consumers have been shifting away from cars, as well as the manufacturers themselves. Certainly the Detroit 3 have been pulling out of the smaller car segments. So some of that is just sort of built into these numbers. But we would kind of think that compact car, which is probably one of the least expensive, or certainly among the least expensive products in the new vehicle marketplace, you would think that they might do a little bit better when we're in the depths of this recession. But I think maybe what's going on here is that the people who buy compact car may have been hit particularly hard by this recession. The hourly workers, the folks who are sort of buying at the lower price end of new vehicle products, they may have been pushed out of the market because of the decline that we've seen in the U.S. economy. And when we look at these same numbers, looking at it by brands, again, the industry's fallen about 23%, but what we can see is that different brands have been falling at a different amount. And these are the large brands, but you can see Nissan has fallen dramatically. Dodge, which is relatively small volume, has fallen significantly. But you can see Chevrolet has been doing a little bit better than the industry average, really on the backs of their large trucks. GMC has been doing a little bit better. Kia and Hyundai are doing a little bit better. And part of that's because of sort of new products that they launched here over the last year relative to last year. These new crossover products that they've put out there have been quite popular, and that's helping them do well. But we can see that it's really quite varied out there as to how the market is looking. And what's happening behind the scenes is where manufacturers are focused. We know that the Japanese manufacturers are heavily focused on the West Coast, as well as some of the more urban environments. Well, those have probably been hit fairly hard by this virus, and so they're in maybe a little bit more of a difficult environment, as opposed to the Detroit 3, which do quite well in the pickup parts of this country, of the southeast as well as the central part of the country. So I think they're gaining some benefit from all of that. And when we look at who's won and lost in terms of market share, you can see that Nissan so far, again, probably on the backs of fleet activity drying up, has been hit particularly hard, while Chevrolet appears to be making some gains. But we can see across the board here, and these are minor, we're talking about tenths of a percentage point in terms of market share changes. But we can see that a number of manufacturers have picked up a little bit, and they're probably getting it in part from the luxury side, which has actually been hit quite hard. And you can see that one thing that's a little bit different when we look at sales changes for luxury brands versus sales changes for the larger brands is that luxury is down a bit more on average. And I think this is not surprising. You know, these high-priced vehicle products, consumers are going to be looking for value, and I think it's going to be a real challenge to get just as many folks out there buying these higher-priced products. You know, they're aspirational, but people are going to be starting to conserve a little bit more, and if they can save some money off of that monthly payment by not getting that premium brand, I think we're going to find more and more consumers willing to do that. And certainly, I think there's geographic influences to this, of course. You know, New York City has been decimated by this. Los Angeles has been shut down for a long time. All of that impacts luxury volumes quite a bit. And then when we look in terms of who's won and lost market share, again, we can see that BMW and Buick have been losing some market share. Lincoln's made a few gains. Part of that's just from their low volume, and you know, so they didn't have that much success last year, so they're building a little bit upon that. But we can see Tesla appears to be making a large gain here, and again, I take it a little bit with a grain of salt, but I think a lot of that can be due to the fact that they just have been able to keep going in terms of making their deliveries, and didn't have to shut down their distribution network in the depths of this crisis. So the big question is what's next? Well, that's the $64,000 question. What we know is that we finished the month of May a little bit better than what folks were expecting. The May light vehicle sales SAR came in at 12.2 million. Our own forecast at Cox Automotive was that we were going to come in at about 11.4 million. So the sales did a little bit better than sort of consensus estimates. So that's a very good sign. And when we look underneath this, we can see that really light trucks continued to make a strong recovery, certainly on the back of these pickup trucks, all contributing. But we're also seeing full-size SUV is doing quite well. But car continues to hold back this market. It's been holding back this market for quite some time. But you can see that the recovery that we saw in May wasn't the same shape for cars as we saw for light truck. And in fact, car share fell to below 23% in May. So we're now a 77% light truck market. So your big crossovers, your pickup trucks, and it seems unlikely that that's going to change anytime soon. And again, that's partly due to by design. A lot of the industry has been getting out of these car segments, so there's just a lot less products out there. But we also know that those car products that are out there aren't selling as well on a relative basis. So it may be that those car buyer consumers have been hit by this virus particularly hard, and they're being chased out of the new vehicle market. And I think, unfortunately, I don't have hard data to defend this, but if I had to speculate, I think that there is some real opportunity within the used car market, that these car buyers are seeing value to get a 3-year-old SUV that I couldn't afford in the new market, but I can afford it in the used market. And so when I'm looking for a less than $30,000 product, I think many of those consumers are leaving the new car segment and moving into the used SUV segment. Again, I don't have hard data on that. I'm just speculating, but my gut tells me that that's where, you know, they're looking for value and they want functionality like we all do, and that's what they can find in the used car market. So what happens from here? Well, our own forecast is that we're expecting the whole year to finish at around 12.3 million. I would say in general, we're a little bit on the pessimistic side of what consensus estimates are out there. I would say in general, it ranges from sort of 12.5 to 13 million is kind of the range that I think most consensus forecasters are at. We're a little bit more conservative now. You know, I just see that there's a lot of hurdles yet to get through for the vehicle market. But the story remains the same, and that is that the vehicle market is expected to see a strong recovery in the next couple of years. We are going to get back to more normal levels, but it's going to take some time to get there. And as I said, the sort of the path that we're expecting is that May we did much better in May than we did in April, but when we get to June, there's real concern out there that we may see a bit of a hiccup this month. One, that we've backed off of the aggressive interest rates that we had offered initially back in March and April, the 0% financing. Some of the luster is off of them. They're not so new anymore. Pulled ahead some buyers into the market from these great deals that we had on pickup trucks. So there's not as many folks that need to buy pickup trucks now over the course of the summer. And the fact that the factories themselves have been shut down during this whole crisis, or much of this crisis, and are now just starting to reopen and facing all kinds of troubles reopening. In fact, I think the F-150 assembly line had to shut down a couple of times over the last week or two because of issues and virus outbreaks that they had to address. That supply to dealerships is going to be constrained, and that may be the next issue that we have to overcome. That it's not going to be that demand is not there, it's going to be that the products that people want to buy are not going to be available. And so we may actually see that this recovery might take a hiccup, a bit of a downturn in June and possibly July if we can't get the assembly lines up and running and get all the store shelves fully stocked again. That's one of the issues that we're watching closely here over the course of the summer. And in fact, it's really this day supply issue that a lot of folks are talking about in the media here over the last week. We have here at Cox Automotive and our vAuto company the ability to kind of monitor what is supply out there in the marketplace. And it's a little bit of a unique methodology. We actually have these algorithms that search the internet for VINs that are being advertised for sale. And we count up those VINs and we dedupe them, so we're only getting single measures. And that kind of gives us a measure of what vehicles are available for sale in the new vehicle marketplace. And what you can see here on the left is that the number of vehicles that are for sale have fallen dramatically. We had inventory available of about 3.6 million just a few weeks ago, and that's fallen substantially. So now we're seeing inventory levels that we haven't seen in about a year and a half. So the available supply has fallen dramatically. Now, how long does this supply last? Well, that's how you get to days supply. Generally, the industry looks at how were your daily sales over the last 90 days, and then you divide that by your available supply to give you an idea of how many days supply do I have available. And what we can see is that the industry really spiked around April 20th, approaching 130 days supply of inventory, so much higher than sort of a 70 or 80 level that we normally would like to be at. But it's fallen dramatically in recent weeks. And much of that can be attributed to that we're well past the terrible period of late March, early April, and this daily selling rates have been improving in recent weeks, and that's pulling down this day supply. But the supply is essentially constrained. There isn't a whole bunch of new inventory that's going to dealerships. So there's a real possibility that if we look at sort of selling rates, over just the last 2 weeks or the last 3 weeks, the available supply could be drawn down very quickly. And so I think that's one of the issues that consumers are going to face when they're going out to the dealerships. They may have the product they want, but they may not have it in the color, or it may not be in the trim level that is my preference. So I think that that's something that, as I mentioned, could hold back this recovery. And then when we look at this for the different brands, this day supply issue, there's a couple of interesting nuggets that kind of emerge from this. So here I'm showing the different brands. And April 20th is when we saw this day supply sort of peak nationally. And I've highlighted that. This is showing weekly data since the beginning of this year. And we can see the day supply for most of these large volume brands all peaked about the same time as the nation. There's a couple minor differences. We can see that Kia is actually still spiking, that they're seeing their day supply continues to increase. But we can see, GMC, for example, has seen a substantial and quick decline in their available inventory, as well as Chevrolet and Jeep. Again, on the backs of these pickup trucks and large SUVs, because that supply has been constrained, this day supply is being pulled down quickly. So the different manufacturers are in different positions right now, but I think that this inventory problem is something that everybody is going to be facing here over the next couple months. But what's interesting, when we look at the luxury brand side of the industry, we can see in red, that's April 20th again, most of these luxury brands continue to see their day supply still grow, even though the national number was starting in decline. And I think, again, this is sort of lending to this idea that luxury sales are being hit a little bit harder, that their higher price points, as well as the states that they sell in, have been holding back their own recovery. Now, most places is starting to show now that this day supply issue is ticking down, but relative to sort of broader brands, it still remains quite an issue. And I've shown this slide before, but I do think it's worth sort of revisiting because I think this is sort of an important view of what's going on in the marketplace. And that is that it's called the brand vulnerability grid. And what I have on here is what are the average transaction prices for brands, and this is based on 2019 data. And then I also have what is the average interest rate that consumers paid or had to agree to when they bought that product. So it's in a way to kind of identify the credit worthiness of their customers, with the idea being that the higher the interest rate I'm paying is probably representing that I have a much lower FICO score. And what we know that's going on in the marketplace is that consumers are being sort of pushed to look for more affordable products. They're looking for value, looking for ways to save money. And so they're going to be looking to kind of shift down from Porsche, with their very high price points, or Land Rover, and look for more value out in the marketplace in general. And that may leave these higher priced product brands out there more vulnerable. But we also know that there's going to be this credit issue that if the economy continues to deteriorate and we see we really slip into the depths of a recession, credit availability may be less gratuitous out there, that we may see some credit tightening, an unwillingness to lend to subprime borrowers or lower credit borrowers. And that means companies like Mitsubishi or Dodge or Nissan, which generally their customer base does have worse credit, their buyers may not be able to get approved for credit. And so I think it's sort of just representing this situation that we have out there in the marketplace where credit availability and lower prices are all going to be pushing on this marketplace. And as we look at this as well by the different segments themselves, we can see high performance car, luxury car, with their high price points, they could be in for a particularly tough year because of those high price points and consumers less willing to buy that aspirational vehicle that they might have otherwise. And at the same token, we also have this idea of credit being less available. And even though subcompact car and compact car have the lowest price points in the new vehicle market, their normal buyers have the worst credit in the marketplace. And so they may not be able to get that credit. And on top of that, as I mentioned before, these very buyers may be the ones who are sort of hit with the first wave of this virus in terms of job losses. Your hourly workers, your retail store workers, your restaurant workers, they've lost jobs in the millions. And that may be part of the reason, as I showed you earlier, that the compact car was down on a year-over-year basis. It may be that the credit is not there for them, as well as their ability to actually buy these vehicles because they don't have their jobs anymore has been hit as well. And I think I've shown this slide as well before, but I think it's just worth revisiting because I think this is something that we in the industry, we tend to think of consumers as only new buyers or used buyers, and never the two should meet. But in reality, I think the market is much more nuanced than that, and that we have, if we look at 2019, we had 17 million people who bought a new vehicle, but we also had another 11.8 million people who bought what we call a gently used, or a model year 0 to 4-year-old used vehicle. And these used vehicles are, have a higher price point. They're not dirt cheap vehicles. They're expensive. I generally have to take out a loan to get these vehicles. My monthly payment is going to be in the hundreds of dollars. And certainly many of the people who bought these gently used vehicles could have bought new, but decided to buy used. And so when we think of the market in that perspective, it's much bigger than a 17 million market. The potential market is much closer to 29 million people, because you've got that additional 11 to 12 million gently used vehicles that are selling out there every year. And so when we think of the marketplace as a potential market, it's interesting to look at this trend of gently used vehicle share, and that we can see in 2013, only about 33% of this potential market was these used vehicles. But it's now risen, and so far year to date, we're expecting it to be near 44% to be these gently used. And so at the same time that we know that the industry has rising transaction prices and rising MSRPs in the new vehicle market, much fewer products that are selling for less than $30,000 than we've had before, the way they're providing that price point to consumers out there is in the used market. That if you're looking for a low cost vehicle, well, the industry's saying you got to go into the used market to get that. So as a result, there's a lot more business that's happening in these used vehicles. But I think this was all fine and dandy when we had a growing economy and there was plenty of vehicle sales for everybody. But now that folks are looking for value and people are going to be pulling back on their spending, these gently used vehicles may become a real threat to the new vehicle market, because I can buy a 3-year-old version of a new vehicle for a 30, 40, 50% discount. And that's going to be significant savings for many consumers out there. And the different manufacturers are approaching the situation very differently. The vulnerabilities are substantially different out there. When we look at by the different brands, on average, it's about 40% in 2019. But some brands are much higher than that. We can see that Dodge, about closer to 50% of their potential market is these used vehicles. But on the other end, you've got Subaru, Toyota, Honda, many of your Japanese brands. They don't get they don't have as much of this used product out there, so they don't have as much of a competitive threat. And I think that's going to allow them to be a little bit more stingy on price. They're going to be in a little bit better situation than some of their domestic counterparts out there. And if we look at this for the luxury brands, it's an even greater issue. On luxury in 2019, about 44% of this potential market was these used vehicles. And all these years of heavy leasing, as well as some fleet activity, has put millions and millions of these gently used vehicles into the marketplace. And so for somebody that's looking to get that BMW badge or that Mercedes badge on the front of my vehicle, there's going to be a lot of opportunity out there to buy one of these gently used vehicles at a substantial savings off that new vehicle price. And again, as I mentioned before, I see that as being a real threat for the industry. Infiniti in particular, you can see that they have over 50% of their potential market is these used vehicles. And so that could be a particularly difficult problem for them. So that's really just a brief summary of what we're seeing out there in the market. If I had to give you a general guidance from here, I would say hope for the best, plan for the worst. I think it's going to be a long, difficult summer. I don't think we're really going to start to see any kind of substantial gains in the U.S. economy until we get a bit into the third quarter, sometime around August, September or so. We really should start to see substantial gains as everyone's getting back to school and the schools reopen, the daycares reopen, many more of the restaurants as well as factories. Things should be much more up and humming by then, assuming that the virus is able to maintain its dormant status, or at least remain in check. As I said at the get-go, we are seeing some signs out there that in parts of the country this is not the case, that the virus continues to get worse. How do we react to that if we do see the virus start to get out of hand in some markets? I think that's going to be a difficult challenge. I don't know that governors are going to have the ability to shut markets down again. I don't know that we, the people, are going to be willing to put up with it again. So I think it's going to be a very difficult summer. But as I said, I think directionally we are headed on this upward path. It's just a question of how fast does this recovery happen, and that's what we're going to have to keep monitoring with our Cox Automotive data. So with that, those are my comments. I'm happy to address any questions if folks have anything they wanted to throw out at me. We will be able to share this presentation, so if you see any questions or have any comments, please feel free to take a look at those slides and send them my way. I'd be happy to get back to you.
Charlie, thanks again for speaking with us today. This is really important information. Again, to those on the line, you'll be receiving a recording of this webinar by early next week. And we also just found out that Charlie will be back to update us again on July 9th. To continue our COVID-19 webinar series, join us back here on Tuesday, June 9th at 2 p.m. Eastern as Jason Miller from Dealer Ops discusses information security in the virtual selling environment. So be on the lookout for promotions on how to register. For more information about AIADA, visit AIADA.org. Thanks for joining us, everyone, and have a great day.